Good morning, everyone. Welcome to this update for global stocks and commodities for the 11th of November. As I've been saying over the last couple of weeks since the correction started, I think it's safe to assume that we're probably in a bit of a different environment now. Whether that plays out in a continuation of volatility remains to be seen, but I think that should be your base assumption, because that is the most likely outcome. So I think the period that we've gone through from February 2016 through to this year, where momentum stocks, momentum stocks had done remarkably well. I think it's time to have a bit of a different platform on which you're making decisions. So my focus certainly is switching to identifying opportunities that are just heavily about stocks that I assess have got quite limited downside risk, both from a fundamental valuation point of view and also from a technical point of view. And so I'm really steering clear of the high PE stocks. So I think that's just a period that we're in. But look, the good news is you can still make some pretty good returns, even in much lower risk stocks, if you're patient enough to wait for the decent sell-offs. So in this update, we've seen a strong advance in the last week, but where to now? The election's out of the way. That contributed to a degree to the volatility, and it would appear that the market has got ideally what it likes, which is pretty much a hung parliament in Australian political terms, because that means the politicians can't really do much, and the stock market tends to like that. I also want to cover why the strategy is just so far more important than timing. When the market is just going up and a rising tide is lifting most boats, it's fairly easy. But we're definitely in a different market now. And so it's really important that you be very, very clear on your strategy, because when the market is going backwards and forwards, if you're not really clear about your strategy, you're going to be constantly trying to second guess the market, trying to time your entries and your exits. And it's a very, very difficult thing to do when markets get very volatile. Be looking at the normal stock and commodity trend update. And last week I provided, as I promised to in the Portfolio Analyst, to look at what I think is a tremendous Australian opportunity in global water purification. It's a company that's it's not quite profitable yet, but it's getting there rapidly, and I think has very, very substantial upside. So let's look at American stocks. The S&P index was up just a tick over 2% for the week, even though it did finish a bit soft on Friday night. And in particular, the big tech stocks, the FANG stocks and other major technology stocks are really underperforming the rest of the market, looking a little bit weak. But that is despite pretty good earnings growth. So it's really just about valuations reverting to the mean. That's what's happening. Corporate profit margins and growth in earnings are at all-time highs. Now that immediately brings out the discussion about, well, this must be peak earnings, so therefore we must go down. But we've been holding this peak level now for well in excess of a year. So there's no reason why, with all the elements that are in place, why this level of earnings growth and profit margins can't continue. Because we're also seeing that the US consumer is really quite strong. Retail sales are up. Same store sales year on year are also very strong. And the consumer is 70% of the American economy. We've got to remember that. So consumer confidence is high, business confidence is high, and that means that people are going to be spending, and it means businesses are going to be reinvesting. So these are all good things. One little black mark, however, is that we're now starting to see some acceleration in wages, and that needs to not get out of hand, because then that can really lead to inflation, which means the Fed has got to put up rates more quickly, and that's never good for the stock market. because of the competition for money, basically, or return on money. Now, growth elsewhere outside the States, Europe is soft. China is still okay, but it's less than it was, and a bit less than people were expecting. So, the growth story outside the US is not quite as good, but nevertheless, I think that's part of the reason why we've had this correction. So perhaps we've taken that little bit of excess off the top. The US dollar was higher on the week. It's broken out, and the uptrend is pretty clear to my way of thinking. So let's jump in and look at the charts. I'll start with this big picture monthly chart on the S&P, and you can see that on a monthly basis, we are still in the mode of higher highs and higher lows. And unless we break this area here, which is around 25.50 on the S&P, then we're still in that mode. Let's zero in though on the daily, and I drew these two boundaries 2 weeks ago, or three boundaries actually. So one would have been the low of the 29th of October. The other one was at 28.20, which was the high of the 17th of October, and with a possible excursion down to these February lows here, which brings us down to around 25.40. So this now, given the strength of this rebound, so you can see we went all the way back and challenged the October highs, which was the first little bounce in the correction. So I think the most likely outcome is that we'll bounce around in this range here. It's possible we might get a little bit of overrun on either side. I wouldn't let that alter your strategy in the market all that much, because little overruns are just a fact of how market operates. But I think the odds are that we're going to stay in this range for a while. It'll probably be volatile. It'll probably bounce around. But I can safely say that if we do bounce out of here fairly robustly, that it's quite possible we could set new highs by the end of the year. But I'm not saying that'll happen. I'm just saying that's sort of what I'm looking for. So for me, it's very much about the pattern of higher highs and higher lows. I think the very short term is unpredictable. It's very hard to time getting in and out. So I'm just focused on buying on after there's been several days of selling, and particularly if there's been some robust selling, I think that presents a good opportunity in relatively low risk, low PE kind of stocks that have a defensive element to it. So there's a lot of American stocks, a lot of American industrial stocks that I would regard as being pretty low risk. Their earnings visibility is pretty high. You're unlikely to get any nasty surprises, and when they're already trading on PEs that are quite modest, around 10 or below, then it's not likely that the price is going to get down too far. So this is a little chart on the wages growth. So you can see we had very high wages growth leading into the GFC, and then that absolutely fell apart, as you would expect. We got down to the trough of that part of the cycle in 2013, and then since then we've been gradually working our way higher. And you can see just recently there's been an acceleration in wages growth. So just something to watch. We don't want inflation to get away from us. Turning now to Aussie stocks, the Aussie dollar was higher again to 72.27, which was interesting given that the US dollar was also strong. And our index was up another 73 points, so two good back-to-back weeks. I think it was about 3% last week, 3.2%. This week it's another 1.2. So things not looking too bad in the Australian index level, but that's largely around a rebound in the banks. The Australian market is just absolutely a stock picker's market. I can't say that I can see any sort of trend or theme on a sector basis, other than the banks, which and BHP and Rio, which tend to move in lockstep with each other. Other than that, it's very such an individual stock market, I think, to be picking winners and losers. Okay, let's just look quickly at the Nasdaq before I move on, so you can see that the Nasdaq was unable to regain or challenge its mid-October highs. So it's a little bit weaker, and that's really a reflection of the big tech stocks. And if we look at this FDN ETF that I've been following, you can see just how much weaker the large tech stocks are compared to where they were if you go back to August. This is weaker than other parts of the market. The Dow Jones, however, is actually has gone above its October highs, so the mid-October highs. So a bit of an interesting divergence there. The bigger stocks certainly being looked after better. This is the US dollar index. So you can see that we've broken some important support. We fluctuated around it for a while, but now we're starting to form higher highs and higher lows again. So clearly there is a very clear uptrend in place that really started pretty much back here in April of this year, and we had a little bit of a pause for a couple of months there, but the trend higher seems to be starting to pick up steam again. The Australian index, we had a weak rally for only 2 days, another big plunge, but now we've come back, and it's very similar to the S&P. So we're back basically to the top of the little October rally that was only for a couple of days. So that's the Australian market, and if we look at the Australian currency, you can see we got two big gaps over the last week and a half, and I'm not quite sure what that's about, because commodity prices I don't think did a great deal. Perhaps iron ore was up during that period. I haven't cross-checked that, but we're still basically in a situation where we're not forming higher highs, and until we do, then the Australian dollar remains in a downtrend. Precious metals, gold sharply lower to 12.10, and that's a bit of a mystery as well, because the US dollar was not up by that much, and we're just getting a little bit of a sign of some rising inflation. So I would have thought gold would have held up better than that. So I have no explanation. That's a mystery. And I do note that precious metal stocks seem to be detaching from the underlying metals, so they don't seem to be responding terribly much with the gold price. And if we look at the gold price on a weekly basis, you can see quite a little sharp sell-off, similar to what we got in August. But if we look at GDX, a much more restrained response from the major gold stocks around the world. But look, if you want to get some exposure to gold stocks, then you just can't go past the Australian producers. The Australian producers that are generating more than 250, 300,000 ounces per year. That's where you want to look. That's where the performance is. They've done extremely well over the last year. So that, to me, is where your precious metals exposure should be. Commodities, copper slipped back a little bit. That was really just currency related. Crude oil got smacked again, down at 61.06. It's now a 22% fall from the peak. So it's just staggering how much crude oil, which just looks so strong throughout the first part of this year, has just fallen back. It's now broken support, as we'll see in a minute, and the futures market is certainly betting on a slowing global economy, and it's certainly responding to some higher inventory levels. But it's still a sector for me that it's extremely volatile, so you only want to go into it when we've got an oversold situation, which I think we're at now. And there's some very, very good US energy businesses that are cheap, that are growing their earnings, and are now significantly oversold. So they could get cheaper yet, but I think there's some great opportunities in energy, and I'll certainly be looking at that in Portfolio Analyst. There's the spot copper chart. Not a lot of change there in recent months, and this is the copper warehouse level that I also watch. The London Metal Exchange. You could see we had quite a strange jump that might. The way that these inventory warehouse levels are maintained and reported is pretty opaque. It's hard for anyone on the outside to really understand what's going on in there. So it's really more about the trends. But a bit of a sharp blip up there, about 40,000 tonnes in copper. There's a crude oil chart on a 3-month basis, so you can see it's been a sharp pullback from $76 down to just on 60. And if we look at it on a 1-year basis, you can see we had clear support here at 64, and that support has just been smashed. And there's just not been a rally at all since we started coming off the boil at the start of October. So looking grim for crude oil in the short term, but oversold conditions always throw up good opportunities. So wrapping it up, I expect the volatility to continue. I think to do otherwise is just foolhardy. But it's a washing machine in the short term, so it's really the trend of higher highs and higher lows, or the opposite, that's important. So that's what I'll be looking for. I really encourage you strongly to develop a low-risk strategy that's going to be appropriate for the next 1 to 2 years. So that's really the sort of stocks I'm looking for. I've showed this the last couple of weeks, and I'll just flash it again for anyone that's new to this particular video. So I'll show you the model that I'm using, but I think this is where the bulk of your attention should be going. Momentum was king throughout 2016, 17, and part of 2018, particularly for the big technology stocks, but it's now far riskier. There's a global trend. These high PE stocks, the party's over. The institutions recognise the party's over, and they're selling out of them. So the approach of just going with strong stocks that were going up is going to be far more difficult. Above all, I'd really encourage you to stay open-minded because the market is going to change backwards and forwards. Just be clear about your strategy and remain open-minded to changing market conditions. Trump is unpredictable. The market's reaction to Trump's unpredictability is even more so. So it makes it a tricky kind of market. Portfolio Analyst this week, I'm just going to be looking for more opportunities that fit the model, and look, there's plenty of them. So whilst we've got volatility and we've got, it's a time when we need to be a bit cautious, there's still a lot of tremendous opportunities. And with these corrections, they've now come back into very attractive valuations. So just to recap, this is what I'm seeking, the ideal stock. I want high earnings visibility, and that comes from strong free cash flow. So that means profit minus reinvestment minus dividends paid out. So after absolutely everything is accounted for, the company still has plenty of cash flow left over. That puts them in a very strong position to acquire weaker businesses or to go into new areas. I'm also looking for earnings growth above 20% per annum for the next 2 to 3 years minimum. And there are still plenty of stocks out there that can offer that and yet still trade on modest PE ratios of 10% or similar. I also want to see the stock be close to the typical band, the PE band that it trades in. So different types of stocks, different sectors tend to have bands that they trade within. So I'm looking for stocks that are trading near their historic lows. So again, it's just another mechanism for minimizing the potential downside. But of course, fundamentals and valuation don't count when the market's in panic sell-off mode. So we also want to have just seen a bit of a meaningful sell-off in price as well. so that we make sure that any excess at all that could be in the stock price has been wrung out of it. So that's the model that I'm looking for, and it's just a matter of being patient and decisive when the opportunity comes. There's my contact details for any non-members, and look forward to what I'm sure will be another fascinating week. That's it for this week. Cheers.